As you might be aware, agriculture and manufacturing have led the GDP recovery this year, coming off a low base in 2017, and that has led to growth of GDP to 6% from 4.7% in the previous year. Other sectors have more or less been stable, with only finance contracting as a result of the rate cap. But moving into fourth quarter, we see a slight deceleration in GDP growth. This is because if you look at the last 4 years, over the last economic cycle, agriculture and manufacturing have always slowed down in the fourth quarter. And therefore, we anticipate that in the fourth quarter of 2018, we could see a slight slowdown in GDP growth to below 6% and might be the slowest growth in GDP in 2018. What we foresee is a slight deceleration in GDP growth to the 5.7 to 5.8% range as a result of two factors. First and foremost, we note that over the last economic cycle, there is this alternating growth trend from agriculture and manufacturing, whereby 1 year there's a growth surge, and then the following year the growth moderates to an extent. But 2018 GDP growth in these sectors came off a low base. As you can see, the manufacturing sector actually contracted for parts of 2017, and the agriculture sector also recorded very low growth and had some contraction in the first and second quarter of 2017. As a result of these two factors, we think that 2019 GDP growth will come in slightly lower than 2018 GDP growth, probably in the 5.7 to 5.8% range. We, however, note that this GDP growth level is still very strong and is double the sub-Saharan African average. Private sector credit growth doesn't seem to have a major impact on profit warnings or profitability declines. This is because you can see in 2014 and 2015, we had a high level of profit warnings despite private sector credit growth in that period being over 20%. We also note that in 2015, which was not an election year, we had the highest number of profit warnings across the last economic cycle. Perhaps where we see a greater correlation with profit warnings is GDP growth, where we note that in high GDP growth years like 2013 and 2016 and 2018, profit warnings tends to decline. So the greatest driver of profit warnings at a macro level is GDP growth rather than private sector credit or electioneering per se. The biggest driver of profit warnings has been direct costs, whether it's raw materials, commodity prices worldwide, or energy costs, or simply local shortages of inputs. OPEX and administrative costs have also been a big driver of profit warnings, where we've seen staff costs and other operating costs surging. And credit defaults, whether it be by banks or by manufacturing companies or insurance companies, have been driving profit warnings to a large extent as well. So these three factors seem to be the largest drivers of most profit warnings based on our analysis. We expect GDP growth to normalize in Kenya in 2019 due to base effects and also biennial trends in agriculture and manufacturing sector GDP. Uganda GDP growth in the fourth quarter may pick up on recovery of the agriculture and trade sectors. Rwanda GDP growth may slow down sharply as the sectors that have driven the acceleration in 2018 GDP revert back to single-digit growth. And then finally, we note that the relationship between listed company performance in terms of profit warnings and GDP, private sector credit, and elections is mixed, whereby we see that private sector credit and election periods do not necessarily correlate that directly with profit warnings, but GDP growth seems to be a greater driver of profit warnings.